The Working Capital Cycle by Jasmine Forzani. The accounting definition for working capital is current assets minus current liabilities. This can also be seen as stock plus debtors plus cash minus creditors plus overdrafts plus short-term loans. And here we have the working capital cycle. To start off at the top, there are cash injections and drains to the business. We see that cash can enter the business, but it can also leave it. Cash can come in many different ways. For example, it can come in from loans, overdrafts, and profit, or even from the sale of assets. However, the cash can also be lost to the government through the form of taxation, as well as shareholders in the form of payment of dividends once or twice a year. In other cases, major assets can also be bought. In the cycle, the cash drains and injections are shown separately at the top because they are independent of the process of production and sale. In order for a business's production operations to be successful, the business must purchase raw materials. However, the buying of raw materials means that cash is lost by the suppliers. After the purchase of raw materials in the cycle, there are the costs incurred by production. The firm must pay for workers and also pay for production costs. In addition, there will be transportation costs because the firm will need the product to eventually reach the consumer. These costs cause cash to leave the business. After production, the business then has finished goods and services that it can sell in the marketplace. The goods are dispatched and costs are then incurred. Although goods are sold, cash does not enter the business immediately. Goods could have been sold on credit terms, and even though the business has debtors, the cash has not yet entered back into the business. Thus, we have the stage, debtors arise from sales in the working capital cycle. Finally, we have the last stage in which payment is received from the debtors. This may happen 30 days or more later, but the cycle is completed and the cash returns into the business. All businesses should monitor these stages of the cycle in order to ensure that the rate of their cash flow is kept stable.